Welcome. I want to begin today's session with a question. When a buyer sits across from you in a due diligence meeting, what do you think that they're actually looking for? Now, most business owners would say revenue. Some might say EBITDA. A few might even say customer concentration. But here's what they're actually looking for. They're looking for the gap between what you think the business costs to run and what it actually costs to run. And that gap has a name in M&A circles. It's called a retrade. And in the lower middle market, it happens more often than sellers expect. So today's session is going to be about closing the gap before a buyer finds it. Mike, who are we here with today?
So look, if you're a business owner doing 2 million or more in annual revenue, and you're thinking about an exit in the next 1 to 5 years, or you just want to run a tighter, more profitable business, you're in the right room. And as a side note, you're going to exit your business at some point, voluntarily or involuntarily. So this is for you. And here's kind of the deal that we want to make at the start of every one of these sessions that we do. We have two goals. Obviously, the first one is to teach you something that you can generally use in your day-to-day operation for cost structure that helps connect the different business layers that you have that are actually worth something to the buyer. And then the second thing is that if we deliver on that, we're going to ask you to take a simple step. And that simple step is to schedule a conversation with us to do an assessment to see where you may or may not have gaps and whether we may or may not be able to point you in the right direction of somebody that can help fill those gaps.
And as usual, everything that Mike and I cover today is for educational purposes only. It is not specific financial, tax, or legal advice. Your business naturally will have details that are unique to you and your situation. So anything we discuss here should be reviewed with your own advisory team before you act upon it. In other words, we're here to educate and to challenge some assumptions that you may have. We're not here to tell you what to do with your specific business.
So this is webinar 5 in our value gap series. If you've been with us since the beginning, you know how we've covered tax strategy, exit strategies, and asset protection. And so today we're going to start getting into, and the ones moving forward, we're going to start getting into the actual business itself. Really the operational side. And so I'll tell you right now, this is the one that surprises people the most, right? So, and then as always, we want to dispel some myths that we hear clients talk about when we bring up these conversations. And so before we get into this content, I just kind of want to lay these out so we address them up front so that we're all on the same page. So the first one that we hear is my business is already efficient. You keep a close eye on those expenses, and that is fair. You probably do. I would ask you to hold that thought as we go through this process before you actually really feel 100% confident about that, because we talk to business owners, and trust me, every business leaks money. The second one is I'm focused on growing my revenue, not cutting costs, and we certainly understand that. Revenue growth is extremely exciting. Everybody talks about it on social media. The other side of that conversation is cost discipline is not sexy, right? Nobody talks about cutting costs. But here's what we've learned. At a 5 times multiple, for an example, a $100,000 in savings could equal $500,000 in actual valuation. So show me a revenue initiative that moves the number that fast, okay? So the third one, I already have a CFO or a bookkeeper handling this, and that's great. But what we're talking about today is different from bookkeeping. We're talking about an audit that a buyer is going to run on your business that you're not running currently. And I promise you, your accountants are not working from a bookkeeper spreadsheet, right? And on a side note, we have this conversation all the time. There is a big difference between a CFO, a CPA, an accountant, and a bookkeeper. You need to know what those are so you make sure that you have the right person in the right seat. The fourth one is I'm not planning to sell for years. Perfect. This is exactly who should be in the room, right? Because the owners who get the best outcomes on an exit are the ones who started this process 2-3 years before they actually needed it. And then the last one is, this sounds like layoffs, and I promise you it's not. That is the last thing that we're going to talk about today.
So strategic cost reduction and headcount reduction, they are not the same exercise. What we're talking about today is identifying structural inefficiency. For example, contracts that auto-renew at rates nobody has reviewed in years, technology that your team stopped using but is still being billed to you monthly, procurement processes that have never been benchmarked against current market rates. These are all recoverable dollars that do not require you to touch a single person on the team.
Perfect. So, as always, if you haven't been with us, I think it's a little important to understand who you're talking to or who's talking to you. So, I came from the investment banking side, helped business owners raise, a combined $42 million and completed my MBA along the way. And here's what I noticed in all of that work. Business owners had gaps, and they're real gaps. They had gaps in their financials, they had gaps in their operations, in their planning, and the advisors around them were not talking to each other. The CPA was doing what they do, right? Tax prep and file. The attorney was doing what the attorney's job does. And other than charging a lot, still questionable. The wealth manager, if they have one, was doing what wealth managers do. But see, nobody was coordinating those conversations to make sure everybody was in alignment. And it's that gap is the reason that we built the National Referral Network. So the difference between ultra high net worth individuals and Main Street business owner is not intelligence or work ethic, I promise you. The difference between high net worth individuals that run businesses and Main Street business owners is the fact that they have a team working together, so all the financial pieces are moving in the same direction instead of against each other. And that is what we're building for owners in this room. We're building more clarity, more coordination, and ultimately better outcomes.
And my 35 plus years in financial services has largely been spent working with business owners on the planning side of wealth management. Mike likes to call me the translator at times. When a problem is identified, I'm particularly good at giving you the mechanics behind the solution so you understand exactly how it works in practice. And when it comes to operational cost structure and valuation, the mechanics matters a great deal.
So here's the assumptions I want to challenge today. Most business owners think about cost reduction as an efficiency project, something you do to improve margins, to run a tighter ship, to look good on paper. And that it's not wrong, it's just incomplete, because it misses the reason that cost reduction is actually urgent for business owners who are thinking about an exit. And the reason is this. When you go to sell your business, a buyer is going to commission something called a quality of earnings report, a QOE. Their accountants are going to spend a great deal of time going through your financials with one specific question. Is your EBITDA actually what you say it is? And they're going to find things that you may or may not be aware of. And so what we're going to go through is the mechanics here on what that actually looks like.
So a quality of earnings report is not an audit. Let's just understand that basic fact. It's more targeted than that, and the buyer's accountants are focused on one specific number, what they call normalized EBITDA. That's the EBITDA figure that they're going to apply the purchase multiple to, and to get there, they're going to test every add back that you've claimed and every adjustment that you made to get from reported financials to the number that you've presented to the buyers. So what that means in dollar terms, per the Pepperdine private capital markets data, lower middle market transactions tend to close at a 3 to 6 times normalized EBITDA, depending on the industry and other factors, of course. An error of, let's say, $200,000 in a normalized figure translates to between $600,000 and $1.2 million in lost revenue. Now, that's not a rounding error. That is a retrade.
So here's what we need you to understand. Cost reduction is not an efficiency project. You have to think of it as a valuation defense strategy. And the owners who get through due diligence with their number intact are the ones who ran the same review the buyer is going to run, found what was there, cleaned it up, and then walked in with a normalized EBITDA schedule that the buyer accountants confirmed instead of contested, right? You want to know where the shadows and the darks and the cobwebs and all the skeletons, you want to bring light to those so they can see the same thing. So that is what the frame is today. We're not cutting costs because it's a good discipline, although it is. We are looking to do cost reduction because you're running a preemptive QOE on your own business before the buyer does it for you, right? So the framework we're going to walk through today is called the CLEAN Audit. There are 5 categories. Each one has a direct line to your normalized EBITDA and to what a buyer will find if you don't find it first. So CLEAN stands for contracts, labor, expenses and automation, add backs, and then normalization. So we're going to spend the middle of this session and most of the session going through each one. But before I do that, or before we go into this, right, I want to reiterate the deal that we talked about at the beginning. Because if we can show you a process that makes sense, that you can do a self-assessment, and that you could realistically apply to your business, like, would you at least consider having a conversation to figure out what partner that you need to actually help run this coordination at a deeper level? And if you agree to that, then, kind of let's kind of dig into this and take notes and pay attention, because this is your business.
So we're going to describe 2 business owners to you today to see, and I want you to see which one sounds most familiar to you. The business owner number 1 has built a strong business, right? They have $8 to $10 million in revenue, solid EBITDA. They have a CPA who files accurate tax return and keeps them out of trouble. They have an attorney who drafted all the proper operating agreements, and they have a wealth manager monitoring their personal portfolio. So they check all the boxes. All 3 are doing a very good job, but none of them are talking to each other. This is pretty common. This owner's cost structure hasn't been seriously reviewed in 2 or 3 years. He has some vendor contracts on auto-renew. The technology stack has grown over time as their needs have changed, and nobody has audited whether all of it's still being used, or even if it's relevant to their current business model. There are a few owner-related expenses running through the business that have always been there, and nobody has ever asked whether a buyer would accept them as legitimate add backs. Now, this owner gets an offer, all right? It's a good offer. It's a good number on paper, and due diligence begins, right? The buyer's QOE team finds $300,000 in EBITDA adjustments that they're just not willing to credit. So at a 5 times multiple, that's $1.5 million off the purchase price. The deal retrades, and maybe it still closes, maybe it doesn't, maybe this owner walks away, but either way, the takeaway here is that the outcome is worse than it needed to be.
Right, so we're going to go through kind of a second profile. Let's call it the same business, same revenue range, same EBITDA. The difference is what happened 18 months before the sale. The advisory team ran what they're calling the CLEAN Audit. They went through every vendor contract and benchmarked it against current market rates. They audited the technology stack and reclaimed licenses that were not being used. They reviewed labor allocations and identified 2 roles that were duplicated across departments. They built a clean, documented add-back schedule so that every EBITDA adjustment had support behind it before the buyer's team ever asked. So the mechanics here are straightforward. By the time the second business owner enters the sales process, there is nothing for the buyer's QOE to find that profile 2 has not already found and addressed. And the conversation shifts from a retrade to a confirmation. And that is a very different negotiation, knowing that you've pulled out all of the skeletons and put all of the financials in a very clean structure. Because here's the hard truth about the profile that John mentioned. It is not a failure of intelligence or work ethic. It is a failure of coordination. We've said this in every webinar. We'll continue to say this. The CPA is going to tell you about the vendor or isn't going to tell you about vendor contracts. The attorney is not going to tell you about the technology stack or agreements. The wealth manager is not going to tell you about labor allocations. Like, you have to ask these questions of your professionals. And if they don't answer them, my suggestion is that you get new professionals. It's easy as that, because each one is doing the job that you hired them for, not the ones that you want them to do, right? And so this is why do having a process like this is so critically important, right? And this is why we're here to talk about this.
So the first category that Mike's talking about in this clean audit is the C, contracts. This is where most businesses have the most recoverable dollars, and it's almost always invisible until someone begins to look for it. The typical pattern here is this: vendor contracts are signed in the beginning when the business needs that particular service, and then they auto-renew indefinitely. No one benchmarks the renewal rate against current market pricing as time goes on, and nobody reviews whether the scope of the contract still matches the actual usage within the business. So in software licensing alone, businesses that audit their tech stack and renegotiate based on actual usage, they commonly find 15 to 40% in recoverable spend. Now, from a Q&E standpoint, vendor contracts matter for a second reason. A buyer's team will review your largest vendor agreements for things like concentration risk, unfavorable terms, and change of control clauses. So a contract with a termination on transfer clause, that can be a real problem for the deal. Finding it before the buyer does gives you time to renegotiate it, but finding it during the buyer's QOE due diligence, it gives them leverage to negotiate. And as the owner seller, you don't want that.
Right. And so, look, the action here is simple. Benchmark your vendor contracts. Pull every vendor contract over a certain threshold, $1,000, $2,000, $5,000 a year. And then look at it. When does it renew? Has the rate changed? Is the scope still accurate for what you need as your business grows? Do you need another platform to get you from point A to point B in terms of growth? And so that review alone tends to surface opportunities most owners have never seen, because quite frankly, nobody's ever asked, right? So the second one is labor. And before anybody gets uncomfortable, we're not talking about layoffs again. I want to be very clear about that. But they are your largest expense. So what we want to do is make sure that things are in alignment, right? And so we want to surface, things like scheduling efficiencies that show overtime, like business or labor overtime each quarter. Roles that have expanded or have drifted over time without a formal review of whether your compensation still matches the market. Functions that started in-house because they had to be, but could now be outsourced more efficiently, or outsourced in alignment with your current employees, right? Benefit structures that have not been benchmarked in years. When was the last time you benchmarked your healthcare? When was the last time you benchmarked your handbook, right? So these are the things that we're talking about.
And from a QOE perspective, labor is the category buyers are going to scrutinize most closely for owner add-backs. I'll give you an example. Compensation that is above or below market rate for a particular role. That's going to get normalized. Benefits that do not transfer to the new owner, those are going to get adjusted. Related party arrangements are going to be questions. Every one of those and more is a potential EBITDA adjustment in the buyer's model. The cleaner your documentation is going into the deal, the fewer adjustments get made, and that's better for you.
So the action is simple. Review every compensation arrangement that is in any way non-standard. Above market owner salary, family members on payroll, we see this one a lot, management fees, and then document the basis for each one. If you cannot defend it, a buyer will not buy it.
And third is expenses and automation. This is where technology intersects with cost structure. Most businesses accumulate software and tools over time as the need arises. The question almost nobody asks over time is whether all of it's still being used and whether it's still the right tool for the right job. And as quickly as technology changes these days, if you're not reviewing your tech stack on a regular basis, there is it's almost certain that improvements can be made in this area. Now, an automation audit does two things. First, it identifies tools that are billing monthly or annually that the team has moved away from, and reclaiming those is immediate, clean savings. The second thing that it does is it identifies manual processes that could be automated. This not only reduces labor costs over time, but, and this is important, it signals to the buyer that the business is operationally mature. I can't stress enough how important that is to a buyer.
It's absolutely huge, and I get it. You know, John and I just went through a change of softwares, and it's not easy. I mean, to evaluate what you're currently using and then change it, and everybody has to change and learn new systems. I promise you, and you know this, it's not easy. But buyers are looking at operational maturity as that quality signal. And a business that is automated, its invoicing, its inventory management, its processes and systems that help create more efficiencies, it signals to the buyer that it's ready to be sold, right? And so it's this kind of efficiency that will increase your multiple when you go to sell.
And the fourth category here in the CLEAN audit is what M&A in the M&A world calls add backs. And I want to spend a little extra time here because this is the one that most directly connects to your purchase price. So an add back is an adjustment to reported EBITDA, and that the seller argues should be added back in because it's either non-recurring or it's an owner-specific expense that will not continue after the sale. An example of this could be a one-time legal settlement or an above-market owner compensation, maybe personal expenses that are run through the business, non-cash charges that are not operating expenses. Now, here's where owners can get hurt. The seller's narrative and the buyer's QOE team's narrative about those add backs are often very, very different. So a buyer's accountant wants four things from every add back. Number one, it must be clearly one-time or owner-specific. Second, it must be documented. And third, it must not be something the business will need to spend money on going forward. And four, it must be presented clearly enough that there's no ambiguity. Vague add backs and unsupported narratives, they tend to get rejected. And the rejection means a lower normalized EBITDA, and a lower normalized EBITDA means a lower purchase price.
And if you know, because you do, that you're going to exit your business at some point, then the action here is to build your add back schedule today. Like 2 or 3 years, 5 years before the sale is even possible. And we could do a whole webinar on why that's important. But every adjustment you plan to claim, have the documentation behind it. And so your business consultant, your exit planning specialist, your CPA, any of those individuals can help you identify what this means and how this looks. And then obviously your CPA can validate that through your tax filing, etc. But your exit planning specialist will model what the approved add backs can do to your exit number, so you have a better idea of that. But this takes a coordination of these professionals to get you the clarity you need.
And the fifth category in the CLEAN audit is normalization. This is the capstone of the CLEAN audit. And what that means is after you've addressed the contracts, the labor, the expenses, the add backs, normalization is the process of presenting your EBITDA in the clearest, most defensible form possible. And what buyers want to see here is 3 consecutive years of similar performance. This is why you want to start this process years before you exit the business. A single peak year, for example, that's going to just be discounted. That's not going to mean much to the buyer. But 3 years of consistent, clean, normalized EBITDA is treated as evidence of sustained earnings capacity. That evidence is what supports the multiple. And the stronger the evidence, the more confident the buyer is in the number. And the less that they're going to have to ask for escrows, earnouts, and other protections.
So here's what normalization means in plain terms, right? You have the CLEAN audit, you've ran it. And I mentioned this at the beginning. Every business, it doesn't matter, leaks money. This audit helps you identify where those leaks are and then secures the leaks, right? And it to John's point, it shows that you've taken the initiative to actually clean your books up so then it is more attractive to a buyer. And so the fact that you've implemented these changes would be huge. And so now, after going through the audit, your financials over the next 12, 24 months reflect a leaner, cleaner cost structure. And so when a buyer looks at your trailing 3 years, as John mentioned, they trend in a way that is more beneficial to the buyer. So you have to look at this from a standpoint of the buyer. And I don't mean to offend anybody, but I promise you every business owner thinks that their baby is the prettiest baby at the pageant. And the reality is that it's not. So this is why this is so important. So here's an exercise we want to do with you right now. Doesn't take that long, but it's something that we can't answer these live, but just something for you to do as you watch this, whether this is live or the recorded. So take your current annual operating costs, not the revenue, not the EBITDA, but your operating expenses for the year. And you could do an estimate for this year, or just what do you right now and 6 months into the year. And so if you have your P&L open, pull the number. If not, just ballpark it, right? So now multiply that number by 10%. It's a conservative estimate of what a structured CLEAN audit tends to surface in recoverable spend for a business at the size that we're talking about, 2 million-ish in revenue. And then call it like 4 to 6 times if you're not sure in terms of the multiple that you believe is reasonable for your industry. If you don't know that number, then that's a homework assignment that you should probably look into so you know where you fit in the world. And so the number you're looking at is what a disciplined CLEAN audit may be worth at your exit valuation. And so I've never run this exercise with a business owner who did not find it larger than they expected, right? So hold that number in your mind as we walk through 2 case studies to kind of highlight some of these things. So that's the exercise, super simple. We like to keep these simple in these webinars, so you have just an idea of what a full assessment would look like, because that is not kind of a future revenue target. The money that you're looking at, the number that you're looking at, may already be in your business. It's invisible to your current advisory team because they're just not asking the question. So, John, let's talk about these 2 business owners, kind of dig into some of these a little bit more nuanced.
All right, let's do that. So in this scenario, we have a business owner named Marcus, and Marcus runs a regional services business, He has about 3 million in EBITDA. He was about 2 years out from a sale when he started working with us. And when we ran the CLEAN audit, the contracts category surfaced the most immediately. Marcus had 17 vendor contracts, and 11 of them were auto-renew. And nobody on his team owned the renewal calendar. So what we found was 3 of the contracts had pricing that had been negotiated 4 years earlier and never renegotiated. And market rates had shifted during that time. After benchmarking and renegotiating those 3 contracts alone, his annual spend dropped by roughly $140,000. And the add back category added to that number. Marcus had been running a vehicle lease and a portion of a family member's salary through the business. Now, both of these were legitimate expenses, but they were undocumented. And when we built the add back schedule and matched documentation to each adjustment, his normalized EBITDA improved further. And by the time he entered the market, his normalized EBITDA was meaningfully higher than his reported EBITDA, and every number had documentation behind it.
No, I guess the question is if you go to sell something, don't you want the highest possible value for it? I mean, it just makes sense, right? I don't know anybody that wants to sell their business if it's worth like 4 million, like the enterprise value is 4 million, and nobody wants to sell it for 2. And so that's why these stories are important, right? Because the second scenario is harder to tell. So I want to call this guy Daniel. Daniel's had a strong business, 4 million in EBITDA. He got an offer that valued the business at roughly $20 million. And obviously he was thrilled. Why wouldn't he be? Due diligence started. The buyer's team obviously went to work. Some things came up, as they always do. Vendor contract that had change of control clause, the buyer obviously didn't like. Set of owner add backs that were not documented to the buyer's standard, and a labor arrangement with the family member that the buyer's accountants flagged as above market compensation. So the buyer came back with an adjusted offer, and that adjusted offer was lower than what was expected. And so Daniel accepted it because at this point, he was so deep in the process, and because he didn't do anything to begin with, he was kind of forced to sell this thing. So he closed the deal, but obviously, like I said, nobody wants to leave money on the table. And so this is why it's critically important to fix these issues beforehand. And all 3 of these that came up with Daniel were fixable, whether it was 12 months, 18 months, whatever that time frame is, they're fixable. But the only difference between Marcus and Daniel was timing and preparation. So, kind of let's bring this together here, right? So we started today with a simple question. What is a buyer actually looking for when they sit across from you in a due diligence meeting to buy your business? And the answer is the gap between what you think your business costs to run and what it actually costs to run. And that gap shows up in the QOE. And in the lower middle market, it tends to show up as a retrade. And this clean audit that we're proposing runs that review. You can run this review kind of yourself before the buyer does to identify these gaps, right? So once again, the 5 categories: contracts, labor, expenses and automation, add backs, and then normalization. And each one has a direct line to your normalized EBITDA. Each one is addressable with the right team working on it, coordinating efforts. So the owners who protect their exit numbers are not the ones with the highest revenue or the best growth story or a specific industry. They are the ones who control the narrative that a buyer was going to write about their business. They control that control starts with an audit like this.
Well, every year that a business owner does not run this process, the cost structure grows more opaque, and vendor contracts tend to drift further from market rates add backs accumulate without documentation. The normalization picture here becomes harder to build, and a buyer's QOE team has more surface area to work with, and you don't want that. The owner who runs the clean audit once and then maintains it annually, they are in a fundamentally stronger position from the owners who arrive at the sales process and then try to reconstruct these years of 3 years rather of financial history under these time constraints. So the first group controls the process, the second group is reacting to it.
So here we are, right? You have a framework now. In each one of these webinars, we provide a framework within a certain topic. So if you've been with us, now there's 5 frameworks that you have to strengthen your business. You have the logic for why it matters to your exit number. The question is how do you actually run it? Because the clean audit is not a solo exercise. Obviously contracts need to have legal review. Add backs need CPA validation. Obviously labor needs HR expertise or some form of HR expertise. But the normalization needs your wealth manager to model what the improved EBITDA does for your personal financial plan. And if any one of these pieces are missing, you're running a partial audit. And that partial audit leaves partial results. And this is why, if you look at the data, 1 in 4 businesses that go to market actually sell. So think about that. If you don't do this, you could be part of those 3 of 4 that do not sell their business when they go to sell, right? So that coordination piece, bringing these people together, is exactly what John and I spend our time building for business owners. And I want to tell you what that looks like in practice. So we made a deal at the beginning of the session. At least we made a deal with you. We said we had 2 goals. We want to teach you something useful about how cost structure connects to valuation. And if we delivered, we're going to ask you to take a step with us. So first off, I hope that you feel that we've delivered some educational value, that you're leaving with some knowledge to go implement into your business. And so here's my ask. We'd like to invite you to a complimentary value gap assessment. It's a conversation. It's a working session where we kind of get to know your business situation well enough to tell you where the gaps are at a high level, but more importantly, who on our team of strategic partners is the right fit to help you address them.
And before Mike describes what exactly that looks like, it's important to note again that we are not business appraisers, we are not certified exit planners, and we are not M&A advisors who are going to tell you what your business is worth to a specific buyer. What we are, however, is the coordination layer that we keep talking about throughout these webinars. We are the financial quarterbacks that Mike has just described. Our job is to look at your financial picture, financial, operational, advisory, and match you to the right strategic partners from the National Referral Network who have a specific expertise in that your situation requires. That's a very different function. And in our experience, it's the one function most business owners do not have and most of them need.
Absolutely. So what does this look like? Well, it's a working session, and I'm telling you, it's not a sales pitch. We're not here to sell you anything. We're here to provide information, right? We're going to listen. We're going to ask questions about what your business is, what your timeline is. What does that look like in terms of an exit? What does your current advisory team look like? Kind of fill in the gaps for that. We're asking, because we want to understand what you have and have not done to prepare for an exit. And so from there, we're going to build a picture of where the gaps are, what your current cost structure relative to what a buyer is going to look for, but more importantly, who on your team is responsible for doing an audit like this? And if nobody is, what does it look like to put that in place? Who are those individuals that we can make that introduction to you to get another free consultation to see what that looks like, right? So when you leave this conversation, you'll know who you should be talking to next. You will know the next step in that process. What strategic partner from our network matches your situation and what that conversation should be focused on. That is the value. It's not an analysis. It's a clear next step that John and I would be a part of as you have these meetings with these partners.
And I just want to highlight something here too. The National Referral Network I mentioned a moment ago is built specifically for this type of situation. You'll have business and tax consultants, M&A attorneys, fractional CFOs, valuation specialists, and all of these people who are accustomed to working together in a coordinated manner. So Mike and I have seen what happens over and over again when owners arrive at the sale process with a team that is coordinated versus a team that is not. The difference in those two outcomes tends to be fairly significant.
Well, if 1 out of 4 businesses actually sell, it is extremely significant. So here's what I want you to do now. You can go to the link that you see there on the screen, the bit.ly.app, or you can scan the QR code to book your value gap assessment. It is complimentary. It takes 30 to 45 minutes, depending. And if after that conversation you decide it's not a right fit for where you are, that is perfectly fine outcome because we're not selling anything. But we would rather have you leave with the clarity that you need to make that best educated decision. But before I wanted to say this in one of those commentator voices you see on game shows. But one more thing before we go, the next presentation, John.
Yes, our next session is in the Value Gap series is going to be webinar 6 of this 12-part series, and it is titled The Accidental Family Office, Building Your Collaborative Financial Team. We're going to take the coordination concept that we have been describing throughout the series and show you exactly what it looks like in practice. How do you actually structure a team that works together? What does the communication protocol look like? And how do you audit whether your current team is doing all or any of that?
Yeah, that'll be fun. I'm looking forward to that. So if today's session made sense to you, please scan the QR code, schedule your time. Webinar 6 is the one that shows you how to build the structure that makes everything work together. So we're going to keep building on each one of those. You're going to see that registration link in our LinkedIn profiles later today. So look out for that. But we'll wrap up. So John, thank you for being here as always. Thank you for attending for those that are here. If you have any questions, reach out to John or I specifically. Either leave them in the comments below, or reach out to us directly via our LinkedIn profiles. But thank you again, and we look forward to seeing you here in 2 weeks.
Thank you.